in our thing, Zoom doesn't work in our computers. You know,
Good
so
evening.
I'm taking.
Welcome to this call. We'll wait for next 2 minutes. Good evening, everyone. I think let's start. We have almost 34 colleagues on the call. So let's start this call. I welcome you in this webinar on this trade credit. And I hope your family and friends and family are doing well. While we all entered into the pandemic crisis, we did not knew that this is going to be drag us so long, so far. But we are in the midst of this and we still don't know how long this uncertainty is going to be there. Preserving cash is a very important aspect in today's business. On top of it, if your vendors go bankrupt, it becomes even a larger problem. So in today's topic, we'll cover up the credit insurance, and I have my colleagues from across branch. I'll request Anand to take it forward and introduce the colleagues to you. Thank you. Anand.
Thank you, Nitin. So thank you, ladies and gentlemen, for allowing us your time. So Marsh India has been at the forefront of providing customer-centric solutions as far as trade credit and other risk insurance is concerned. Today we have on the panel a number of luminaries to tell us more about it. Our first speaker is Mr. James Chelia, who is the CFO at Tata BlueScope Limited, and he has that position since December 2013. A CA with over 25 years of post-qualification experience, he brings with him a track record of building business partnership, lies in production experiences, and stakeholders across international geographies, creating business plans, actively engaging in teams, and devising organizational strategies for sales, manufacturing, distribution, sourcing, and likewise. Before joining Tata BlueScope, he was working in a number of multinational companies like AstraZeneca in an internal audit role, as well as the CFO for the listed subsidiary for about 8 years. So over to you. We would want to hear about your thoughts on trade risks that you see in the industry and your company per se. Thank you, sir. Sir, you're mute, sir.
Yeah, thank you. Good afternoon, everyone. It's a pleasure to be here to share with you a little bit, give a little bit of perspective about this credit insurance and more so how it is practiced in our organization. Ours is Tata BlueScope Steel, which is a steel company where we buy steel coils and we coat it, either metallic or paint coated, and then it is sold to the market as profiles or in coil forms to various types of customers. So that's a business where if you look at from a profitably perfect from a margin perspective, the margins are not too high in this kind of steel businesses. So it's very important for us that whenever we sell, we need to ensure the money comes back. So, what in our organization, we very clearly tell that our sales, we consider it as sales only when the money comes back to us. So I just want to start off with that because it's very critical that, unless the cash cycle is done from, order to cash and the cash comes to you in your hand, it's really not a sale. So how do we manage it? And that is what, I thought I'll share with the audience here. So basically, when we talk of managing debtors, it's often called, credit management. And what is it? Finally, to me, it's a kind of a risk management philosophy that is applied when it comes to credit risks. Okay, so when I sell to a customer, I would like to know whether the money is going to come back. And definitely, when I sell, depending on the industry in which we are, the practices of the industry, the customs of the industry, plus the risk appetite of the company which is making the sale, as well as the credibility of the customer to whom it is sold, we take calls on, what's the kind of credit that we give them. So to me, it's basically when we talk of risk management, it is basically a risk management. When I talk of credit management, it's a risk management. What is risk management? It is about understanding what are the risks in terms of when I make a sale, what is the risk that I'm taking? When will the money come back? How will it come back? So I look at all of this and then take a call on how to manage it. So different companies manage it differently. Some people have a clear policy saying that it is, cash on delivery or advance and then the delivery. Then some companies have, bank guarantees or they have LCs. They have various ways in which, they address this problem. Because the customer, when he buys from me, he expects to have some credit. Yes, we are happy to give the credit, but we need to ensure that, the money is secure, that it will come back. So we have these are various things that we have as credit management instruments. So, in the steel industry, if you look at, basically it's, we always go with advance. That would be the first preferred way because the cost of good is very high. Our margins are low. So for instance, if I'm to sell 1 ton of steel and, I'm making a profit, say if I'm selling it at 1,000 rupees, and if I make a margin of 100 rupees, now if that 1,000 rupees doesn't come back, I need to sell 10 tons of steel to make up for it. So to me, it's about how do I ensure that I get this money back securely and I can sleep well at night. So we do have, various things. So for project business, we ensure that, we have bank guarantees, we have LCs or, bank guarantees or, it's all clearly tied up with, funding agencies. So all those things we do, but still finally what happens is there are a set of customers who are very strategic to us, or, these are customers like, where they are doing project business for others. So in that case, they definitely require credit. And some of them are very strategic to us. Some of them, and the tradition of that space is where we have to give them credit. But to me, how do I then ensure that the money that the sale that I make, the money really comes back, say after 30 days or 60 days, or whatever is the credit limit, credit days that I have given them. So this is where, this whole thing of trade credit kicks in. This insurance kicks in. And so when we have done our analysis in our company, we have clearly defined, different segments of our business where, we know what the risks are and we know what should be the credit limit, what and when the money has to come back. So we have defined it. Ours is, say, a 2,000 crore company, but we have this one specific area of the business which is around 200, 250 crores, where we have to provide this insurance, this kind of a credit to customers, and we need to ensure that it is kind of secure. It is secure. So we have, in that context where we have gone in for this credit insurance. And to me, this is a thing which we have gone in right from 2012, end of 2012. And since then, we have been having this. And to me, when I do my sales to these customers, and when I report back to my board, they ask me, James, are you sure about this data? So much of data is there. How sure are you that you'll collect it? Especially, when I consider it in today's context of the pandemic, it is all the more important to ensure that the money comes back. And the boards are, frequently asking this question: how, are you sure that you're going to get back the money? And I tell them, yes, these are the risks that I run for these various parts of my business, and this is one area where I've covered through this credit insurance, and that gives not only me me a good sleep, but also to my board. Yes, the monies are going to come back. So essentially, this has if I'm to sorry. So we have had this, insurance for the past, as I said, about 8 years. The good thing is, so far, we have not had any bad debts. So it's really not that, we had, had the opportunity to, opportunity to, to really get money back through the insurance, which is good for us, in that sense that I'm really happy because my credit management team is really good, doing a great job. And, we've been able to get back our monies on time. And there's been no unfortunate bad debt write-off. My debt back, in case in the unfortunate instance where the customer is not able to pay back. And again, I will not always default the customer. Customers, I don't think, always have a thing of defaulting not to pay. There could be various circumstances because of which, they default. And in today's context, especially in the pandemic situation, we just cannot say when and how this can go wrong. And it is very important that, we cover our residual risk of, through this kind of, in I would say, a tool, which is this insurance. And going back, okay, the next question that you might ask me is, well, yes, we are covering this risk, but always there is a risk benefit involved in these things. So what is the cost of this? So when I look at it, it's costing about, 0.12%. Yeah. So we cover about, we have a risk profile for about 200 crores, but we cover it for about, say, 180 crores, 160 crores of our business through this credit insurance. And so at least when I look at it, whether it is a benefit to me, I definitely feel it is a clear benefit because I'm assured that I'm not going to lose. And if at all I'm going to lose, there will be some loss of interest cost and loss of the profit. But definitely I will be able to recover the cost of goods so that, I'm to that extent secure. So from a cost perspective, I definitely see a great advantage here. And it makes a lot of sense for us to, have this kind of a risk mitigation plan for ourselves. And if you look at this pandemic situation, there is this moratorium which has happened, and banks have given customers the moratorium. And one of the studies, recent studies from the credit agency says that out of this, people who have gone for moratoriums, at least 72% of them are companies that are going to default. Even when the moratorium is over, they're going to default. So that is the kind of situation we are in. And for us to really understand each of our customers, where we have exposures, to really control all of that is going to be very difficult. And you will have definite pressures from your salespeople also, because in this kind of a situation where the sales, to make sale happen itself, is going to be a pressure, is going to be difficult. You need to, we as finance or risk managers should be able to give them some avenues for securing the sale. So this will definitely help companies to use this instrument for managing this risk and enabling even the organization to grow in these difficult times. Plus the other thing which also the benefit that you get is because they provide this credit insurance, many of these insurance companies, they also have a credit team, team which profiles the customers. So in fact, you get to understand, you get a profiling of the customers, their credit worthiness and other things through this team itself. So when they provide you risk insurance, they also just don't blindly give it. They also look at the profile of the customers. They know how much of a risk can be taken. So if you say, oh, my monthly sale to this customer is about, say, 3 crores, and so I'm giving them a 60-day credit, so at any point in time there will be 6 crore of debt. They look at their profile, they look at the customer's credit worthiness, and they say, okay, no, we can't take so much of risk. We will be able to take only about 4 crores. So that by itself gives us an understanding of the customer's credit worthiness. And so taking that as a cue, we can also manage our business, our exposures to those customers. So these are the other benefits that also come along with taking this. So at this point, I would like to hand it over. And probably we can have a discussion once the team has gone through what they want to speak. Thank you.
Thank you, sir, for a very precise business perspective from your industry and how the questions that you have to answer to as a CFO to your board. Now, to answer a couple of these questions that has been raised and to touch on other parts, we have with us Atul Jindani and Akshay Bhardwaj with us. Atul has been has been an insurance professional for over 15 years now, into various roles from marine, and has mostly concentrated his career in the credit risk as well, and in insurance companies as well as in the broking channel. Akshay, who heads this practice for us in Marsh India, has over 20 plus years of experience in this, has started a number of verticals into this, and for the last 15 years has devoted his energies only into this business and insurance companies and in the broking fraternity. Now I welcome Atul and Akshay to take this forward.
Yeah, thank you, Anand, and thank you for the brief introduction. And Suresh sir, thank you so much. I believe you've taken us all through the whole slides in short, in a nutshell. You've given the whole perspective of how your organization uses it. In fact, this product or this solution or a trade credit program which we will be talking about, what we also see is this is one of the closest insurance solution, you can say, of C-suite, all the C-suits, primarily we see the CEOs and CFOs, because they're more concerned about the receivables and the balance sheet protection. So without further ado, I will just initiate and begin in terms of few of the aspects which we want to cover today. One is with respect to the pandemic risk. So this is a brief you can say a profile of the risks which we see. It includes all the risks, economic, environmental, geopolitical, societal. However, something interesting to be noted is the infectious disease, which we see here in the red. We've been seeing infectious disease, we have been mapping it, we have been talking about it, but nobody had thought that this one infectious disease would make all of us stand still, and the whole world probably would be at standstill. The likelihood is quite less, but the impact of it probably post pandemic now, this graph would probably change, and maybe the impact could be at peak. So just wanted to give a perspective of these the impact which we are having because of this current pandemic. And when we see here, when we extend this risk of infectious disease, we see that this is linked to so many other risks, which includes maybe food crisis, climate, cyber. It is all related, but the primary aspect for which we would be more concerned here is the financial failure, which you can see at the left side, bottom left, where, and we are seeing this, we are seeing the financial crisis, financial failures of companies. Primarily every quarter, every week, we see one of the two of the companies in US or UK filing for protection. So yes, this risk is there. It is very much, we are within, it is between us. How do we mitigate it? So here comes the aspect of the societal and the macro level aspect. We also know what has happened is in the past 180 days, the various aspects of lockdowns and maybe the market slumping. But with respect to corporate challenge, what has happened is, and for which we are more concerned about, is the liquidity crunch and also the rising default risk. And as Suresh sir shared about the recent report, which talks about 73% of the companies who are now surviving on currently the moratoriums may and are likely to maybe not pay, or not able to honor their commitments in terms of maybe to the vendors or to the banks. So this risk is what we are very much concerned about, and all of us are sitting in between it. The long-term fallout obviously would be societal, political, economic, industrial. But in the economic fallout, yes, what affects us with respect to the trade program and these policies and the financial risk is the economic aspect, where we see the global majors and the US-China challenges, and with the economies, probably the recent report of IMF, in fact, we were just browsing, it talks about almost every economy is going to have some notches down, minus growths. So this is what we are seeing. And probably, as Nitin also shared in his initial introduction, that we don't know, is just the beginning. These 180 days we have just experienced, and let's look at what's in the future. So can we do something about it? Can we look at, maybe can we try to mitigate it to the best possible extent?
Atul, if I can just add one point here, this is Akshay.
Yeah.
Student of trade credit political risk as a subject, what I have observed is, if we take our history post-industrial revolution, every time there have been an economic stress, it is very closely followed by a political upheaval. Same goes with, in case of a political mess, it is closely followed by an economic mess. Now, I can always delve deeper into it, but this is one situation where the whole world, and if you can go back in history, post World War II, I think this is the first time the whole world has come to a standstill. This is actually scary, and whatever people say in terms of what it's going to be, but situation is not sane in terms of doing business. And as Sir also suggested, Mr. James, that we don't know where it will end and how and what it will leave behind. So in terms of risk mitigation, whatever available tools we have, or if we have not even thought of earlier, whatever we have, we must exercise them, because the results would be unexpectedly, it could be unexpectedly bad, good, or ugly, or whatever. We frankly don't know. As a practitioner, risk practitioner, I believe this must be remembered, that this social or economic upheaval will lead to political issues, and then there is a whole cycle. Unless everything settles down, the world goes to a reset process, things are not going to improve. Atul, over to you.
Thank you, Akshay.
Yeah.
So, okay, this is on a lighter note. Probably no, we were discussing that, okay, the gap and the IFRS would also add, no, from the next year. It was EBITDA, now it will be EBITDAC. So basically, coronavirus also aspect has to be considered in the, while reporting financials, because it has impacted companies so much, and all of us, this should be considered. Anyway, this was just on a lighter note. Talking about now the growth projections, and this is just recent update of July, which is from the IMF, that the global growth projected for 2020 is already in about minus 5%. And what we see is next year, we already have a projection which is almost 6.25% lower than which was supposed to be at a pre-COVID level. So yes, economies are likely to get impacted, companies are likely to get impacted, and we also see insolvencies, which will be almost, we've seen, I think, especially in US and UK, companies, large companies, 100-year-old companies, and there is, the list is long, and we all know about so many of them. Every week, they are filing for protection. And because most of it was covered, our export houses are protected because they had a cover. So yes, that's one more context in terms of the protection which is available by virtue of buying a trade credit program. With respect to sectors, almost 100 plus sectors being downgraded, and the confidence is currently at a little low, and economies to be shrunk. So it's just not that, no, it's a doomsday and everything will crumple down. But yes, let's agree to a fact that situation is likely, and we don't know about this situation, which is likely to go maybe a little more adverse. And can we be more prepared for this? Can our companies, can our balance sheets be more prepared for this? This is a perspective about trade credit insurers, or the markets as we call them. And as we see, if you see the global three majors, they are the monoline insurers, which is Euler Hermes, Atridius, and the Coface. They are the world's largest three. And if you see, almost together, the trio contributes to almost 80-85% of the trade credit market. And all three are also present in India with their respective insurance partners. There also, the combined ratios are, in fact, we are unable to put the recent figures of 19 and 20, but we yesterday had a call with one of the reinsurers, and we understand they already are sitting at 85% year on year as the last month, and we still have 4 more months to go. So a loss ratio, a combined ratio of 100 plus is not a very comfortable situation which insurance company would be in. So what we see is, yes, their loss ratios are increasing, the combined ratios are increasing because they are paying claims, and they're paying claims because the claims are coming in, and claims are coming in because companies are defaulting. So this is a ripple effect, and this is just to give a perspective of what the companies are sharing.
Just one point, Atul. So broadly, if we can understand what we can understand from the slide, that in today's market, if we are looking for coverage, it is going to be much lesser than probably some time back, because the exposures which underwriter carried have been reduced by almost 40 to 50%, and it is actually getting tougher to get cover. the prices have increased from anywhere between 30-40% to 100-200%, depending upon the sector. But how we look at it is that even in these situations, people who have opted for insurance, even they have seen losses mounting. And they are coming from one of the most trusted buyers, because sometimes you know your buyer, but you don't know your buyer's buyer. If they default, your buyer also defaults. And that is where insurance comes handy. And I think that is the whole purpose of buying insurance. 82% of the market is controlled by these three, and if they all are in red, it means that the credit insurance market is going through a very tough phase. The positive aspect of how we look at it is that the claims are getting paid. And in the later slide, Anand will show you that we are the only brokers having a dedicated claim desk, and we are seeing huge amount of claims which are processed in this period, and unexpected huge losses. In India, we never saw claims worth $1 million, $2 million, $3 million equivalent, but we are seeing them and they are getting paid.
So this is with respect to, we all know mostly now about what this cover is. So it's basically the seller offering the goods or services, the buyer utilizing and paying after utilizing the credit period. So basically the cash flow cycle is the core of every business, and which is probably the heart of every business, because every business has the primary role of generating money. And that's where the challenge comes in. What if the buyer does not pay? And we know, and what we also hear from most of the companies, that organizations tell us that my buyer is using me like a banker. And the reason being, if I'm offering a credit of 60 days or 30 days to my buyer, he can, if he delays payment, and maybe if he pays me after 90 days, he's utilizing that window of 60 days, and where he can utilize it for his working cycle. So that's where, if given a choice with the buyer, he would maybe delay and maybe pay at the fag end. However, for a seller, yes, this is a very important aspect, and that's where this program or the solution comes into play, where one is it protects the balance sheet. And not only that, there are various other benefits which are linked to this program, right from increasing your business. So in the next few slides, we will see that this program not only protects only the balance sheet, but it also helps you find the right buyer. It helps you assess the buyer, monitor the buyer, even helps in collection and recovery. And if all this fails, then you have the base safety net of getting the indemnity or getting the claim as well. This is about the cover. You can have a cover either for your domestic receivables or export receivables, or both. The primary cover becomes an insolvency or a protracted default. Insolvency and bankruptcy, that is one. We all understand the insolvency and bankruptcy cover. Like, I can just to give you an example, in 2018, and I can take the name because we all know this is in public domain. Aircel filed for bankruptcy and insolvency in March 18, and most companies who were insured, they actually were they were safeguarded. But those who were not, they had to write off a big amount of a debt from their balance sheet because of the non-payment. So that is an example of an insolvency, a buyer going insolvent. Protracted default is a delay. Buyer delaying would be covered under the protracted default. When you have exports, or when you have a cross-border transaction where Indian companies exporting services or goods, there is another dimension of cover which triggers in, which is a political risk. And that's where you see it on the right side, where you have currency inconvertibility, government action, or public government default, that can also be covered. One aspect here is this is primarily taken by corporates. We have mentioned banks here. So this is under IRDA consideration. As we speak, a bank in India cannot take a credit policy. However, this was possible by up to 2009, and then there was a regulation which came in, and then this is again getting revised for good, and that's what currently we're in midst of a lot of changes which we are seeing. So hopefully we would see that banks may also be able to take these trade credit policies. Now, this is something where it talks about what can be covered. Now, who would be the user? The user would be companies who would be offering services and products, and the banks as well. Once it gets, once India gets a confirmation. However, we see globally and especially in Europe and in Americas and other continents that banks are the largest users of this trade credit program. So almost 40-50% of the market size would be insured they would be taken by banks, where banks are buying these policies on behalf of their customer, who would be companies, because they're lending them. Whereas in India, currently it is only the company who is offering services or goods can buy it. The industries we've seen programs, and we have 100+ programs if across industries and segments, be it services, IT, to maybe you can say FMCG, to IT distribution, to commodities, to farmers. So it is across sector and crisscrossing all exports as well as domestic. So this program can be taken by any sector and segment. However, yes, there will be some programs, some sectors which are more preferred by the insurance companies, and some could be little less preferred, but we have programs across sectors. This would be the most important slide with respect to trade credit understanding, and I will probably take 2 or 3 minutes and spend some time here. What does the cover? Now we all know what is the cover, and how does it help, and what are the other benefits to it? One is, yes, bad debt protection. So it transfers your risk, and you almost to the tune of 80 to 85% of the risk can be transferred to the insurance company by using the effective use of this policy. Not only that, it also instills a lot of credit discipline and a credit. So it works like an outsourced credit management arm of a user company. So a company buying a trade credit policy is not only just signing the program and meeting the insurance company annually for the renewal. This is probably the most engaging policy we would probably have in any of the insurance programs. One of the most engaging policy, where it is working like an outsourced credit department for the organization, where you ask for a limit, you can give the names of the buyers, insurance company helps you assess the buyers, they help you set limits, they help you monitor the buyer. And one another aspect is insurance company also is in the business of informing about the adverse buyers to you. And that's where the biggest information comes into our policy holders. We all would agree that information is the key to any business. And once whoever has the first information and the right information, you would be able to either recover or take action on the buyer, or whatever perspective needs to be, or action needs to be taken by the organization. You can take that, and by early warning signals, which is being offered by the insurance company by virtue of their analysis and monitoring quarterly, we have seen most of the policy holders have saved a lot of their monies from the debts or from it going against a bad debt. Another aspect, safe business growth. We discussed about this, that they have about 70 to 80 million companies of database. So if I'm a company, I would want to, I'm very strong in maybe West market. I want to start and expand in maybe North. So I can give maybe potential names of all my buyers whom I want to do business with. Insurance company will help me set up limits. They will cover the limits. They will give me a protection. I can start selling on credit to them. Without this policy, maybe I would have thought twice should I offer credit to somebody new or not? So it helps you grow the business. Ultimately, what we also hear from our policy holders is this is one policy which even pays its own premium. So whatever premium you pay for this, for buying this program, the additional revenue which you generate is much more, and the profitability, and if you consider the margin and you calculate and do the math, it is much more than what the premium is being paid. So all in all, yes, this is why especially all fast growth organizations look at taking this program to augment their growth and protect their balance sheet as well. This working capital enhancement also is the one of the possibility of this program, where it even helps increase the working capital, and it also gives the banker a little more confidence. So if you have this program,
Just Atul, if I just give you 2 points here. One is this is under IDA consideration, where you can globally you can factor or discount your invoices backed by, so which is done by a bank. Now these banks also buy credit insurance in the background. Globally, almost 50% of the credit insurance is bought by banks and not just by corporates. Uh, in India, it was banned in 2010 with all the active work which Marsh and other people, stakeholders have done. We expect that probably by this month end, you can have insurance-backed bill discounting and factoring services allowed in India. This will provide a lot of impetus to Indian companies because currently the bankers are doing assessment of the buyers basis their financial strength. Now that will be done by insurers, so they will be able to support more number of buyers, and that will help manage working capital more efficiently. One thing which Atul have explained, and maybe I like to touch upon on this aspect. So while credit insurance helps you choose the right buyer, choose the right exposure. In case of default, trade credit also helps you with debt recovery. And this is a very important aspect because debt recovery in itself is a very expert field. These companies have their own in-house debt recovery experts who assist in debt recovery. And one very important aspect which we do not look at or is not widely talked about is that it also pays for the debt recovery charges in the insured thing. So for example, if you have a $100,000 loss, and say after the claim waiting period, your claim is paid, and when it goes for recovery, there is a huge legal cost to recover it. And insurance companies pay 85 to 90% of that cost. I think that should also be a key point to be delved upon when you're looking at credit insurance. Another aspect is that the debt recovery percentage before a claim is processed for insurers range anywhere between 45 to 55%. So in case of 45 to 55%, you know that your money would be covered and there would be a no claim situation. That in itself is a very strong proposition when you're looking at credit insurance. So one is debt risk mitigation or risk transfer. Another is credit benchmarking. Third is debt recovery. Fourth is legal cost, which insurance company will also take care of. And that's what I believe Atul meant by suggesting that this particular program pays for its own premium. Right? Over to you, Atul.
thanks, Akshay. On the right side, in fact, Suresh sir already explained, and this is the very same aspect which he was talking about, that no, if there is a loss, how much additional sales needs to be done by the company or the organization to make good the loss. So all in all, this is basically more of a complete outsourced credit department, you can say, or a credit management solution, rather than just an insurance policy. Here, if we see what can be covered and how it can be covered, the little further nitty-gritties. Primarily, we see in India, it's a whole turnover program, in the sense, as an organization, whatever you're selling on credit, you need to offer all the credit sales to the insurance company to be covered. However, you can select based on maybe segments, geographies, your channels, that can be possible. So in fact, here sir also explained that they have covered one segment of business out of the total turnover of 2000 crores, about 250 crores roughly. So that is a segmentation that is also possible. However, what is not possible is random picking and choosing the debtors or the buyers and offering it to insurance company. That would come as an anti-selection. So a homogeneous group selection is possible, very much possible. Single buyer for specific sales, currently in India, domestic policies are unable to offer single buyers. However, if you have exports sales or cross-border sales, then we can look at single buyer that is only from one PSU insurer, the ECGC. Now, which sectors are, so as we discussed in some of the previous slides about the sectors which we have, and I shared that we have insurance companies having the preferred and referred sectors. So the general preferred sectors would be in green, which is basically food, agro, chemicals, retail. Then maybe the amber would be again service, IT, software. Something which is currently in red, and yes, this probably so before COVID this was not in red. This has changed the times because of this current times, but what we see is, yes, insurance companies are gradually also looking at this. So apart from apparels, auto, something which is in deep red is basically gem and jewelries, which is very, very restrictive for insurance companies to cover as a sector. But yes, any proposals which are there, we are happy to relook at across the sectors. So this is basically just to give you perspective about our team and what we do and why us. So as Marsh JLT, we are happy to share that we are one of the world's largest insurance broking company, and as Nathan also shared, for trade credit we have a separate practice where we have a separate 4 lines of products. One is trade credit, which we are talking about. There is political risk and sureties, which Akshay will take maybe at the end for some time in few slides, just to give you a perspective of what that is. And there is something called a structured finance. This is basically for banks. So all 4 lines of credit specialty is something which we are contributing to. We also, as Marsh, one of the biggest trade credit contributors for the reinsurance companies. We saw in the previous slides the global majors, the global trio being introduced, Coface and Euler. So Marsh globally is the largest producer for them, and by virtue of that, we also have a good leverage with these insurance companies and the reinsurers. In India as well, we have a strong leverage because of that, because we are one of the biggest contributors for all the TC majors. There is another market in India, which is ECGC, the insurance company, which also looks at trade credit, but only does export trade credit. So they are not in the domestic space, but if you are exporting, ECGC is also one insurance company, and we are also working very closely with ECGC. And recently they have there are some new programs also coming in by ECGC, their internal committees under discussion. And what we see is a very strong support from ECGC also to support the Indian exporters, to protect them and to protect their balance sheet. Last but not the least is the claims desk in fact India, and this is the claim desk where my colleague Manish, he represents the Asia Pac claims desk, and we happen to be one of the only brokers where we have a separate claim desk only for trade credit claims. Because we do so many programs, because by virtue of so many losses coming in, we have a claims expertise where we see almost in India, roughly if you see about 1,000+ claims, so almost 970 claims we've seen in the last 6 years, and about 148, 150 claims now which are under process. So yes, there are claims, in fact, and in fact all of these claims, either the recoveries come in or they would get paid. It's a very clean and a clear program or a policy, and that's why if you can connect the dot that claims are coming in, insurance companies are paying the claim, and that's why their loss ratios are also increasing. So the claims definitely get paid, and in fact, including one of the largest claim in the Indian market, which was about $3 million. I think Akshay was sharing that we had not seen such large claims earlier, but last year we saw one of the claim of $3 million, one single claim, which was processed for one of our policyholder, and we have so many others which are actually in the pipeline because of the current COVID impact. So
if I can just, Atul, if I can just sum it up, uh, broadly, we as Marsh want to present ourselves as your partner basis three things, that is our knowledge, leverage, and promise. Knowledge which is derived from our global expertise and the support what we have globally. It is not about Akshay or Atul or Anand or Nitin servicing you, but an organization of the size of Marsh, which has huge 150 years of knowledge which comes to your disposal with respect to clauses, with respect to policy wordings, with respect to structures. Second is with respect to our leverage. Obviously, being the largest producer, to give you an idea, for top three, that is Atreides, Coface, and Euler, globally we generate between 20 to 35% of their book, which comes to your disposal. So any claim or any situation or any policy wording or any structure which is sitting on the fence and requires a push, Marsh as an organization is capable to deliver. And third is promise. We are not here just to deliver you the commercial terms. We invested and set up a desk for claims to ensure that when the need for the insurance policy comes in, that is the claim, we are able to live up to your expectation. Anand, can we move to the next slide, please? So broadly, this is how our team looks like. I'm responsible for this profit and loss account, though the business is done by everybody. Atul is leading our trade credit practice with Varun, Aditi, Kirti supporting him. Anand is our coordinator for Pune. We have Manish, who's taking care of claims desk. We have a dedicated ops desk to take care of day-to-day exercise regarding internal as well as external. Suchita comes with almost 20 years of experience, 15 plus years of experience in credit insurance and 5 years in operations. Vishwajit and Rishabh are taking care of structured trade credit, political risk and sureties. We will delve onto it. Next slide, Anand. I'm just rushing in so that we have more time for question answers. Anand wanted me to discuss about surety bonds. Now, surety bonds are nothing but bank guarantees which are issued by insurers. Globally, this is a very popular product. In India, insurance history is about 20 years, 20 plus years, where private sector came out with a lot of innovative products. Earlier, it was pretty, what we say, static to a great extent. And I'm not demeaning anyone, but new avenues have started coming in. Now, in India, now the environment is getting slightly better for surety. IID has formed a committee, and if everything works well, maybe in a year or so, whenever you require your bank guarantee, rather blocking your bank lines, you can actually utilize insurance-backed surety, which is much cheaper, and also it does not require collaterals. Any help, any additional information you require, we are more than happy. In India, we cannot assist you, but we have been helping Indian clients get sureties abroad. In last 3 years, since we have actively started working on it, we have placed sureties worth $650 million, and that gives us like a lot of comfort. As I said, as Marsh, we have that global connect, and that helps. Broadly, this is how it looks like, which is represented over here in the slide, where the project owner, when it asks for the contractor to give, say, performance guarantees or advance money guarantees or bid bonds or retention money bonds, we find an underwriter who issues the surety on behalf of the contractor, and in lieu, the contractor has to sign an indemnity bond or indemnity agreement with the surety company. All this is facilitated by us. So how it helps you is that, say for example, you're doing a project in Africa. Sureties are accepted in 120 plus countries. Say you're doing a project in Africa, and you need to give for 100 million project, if you need to give a $10 million surety, Rather giving a bank guarantee and blocking your bank lines, giving collaterals, we can arrange for a collateral-free surety issued on your behalf on the same price which you are paying for bank, or maybe lesser depending upon your financial strength and the project. Next slide, please, Anand. Globally, surety has evolved. As I said, for everything we have sureties. From rental deposit to bid bonds to court bonds to custom and excise bond. I think it is written exercise, it should be excise, performance bond. But what we would be concerned over here and what I look forward is construction bond, which is the need of the hour for the nation. We understand this NHI is going to issue contracts worth $1 trillion in next 3 to 4 years, which means about $200 billion of guarantees to be issued. Our submission to the ministry, and we are using Marsh's office, our CEO's office, to push to ministry, to IDA, and we have been doing it from last 3 years, that banks are already stressed. You cannot put them under further stress by $200 billion of guarantees and almost $1 trillion of project funding. And this requires some innovative products. So this is going to come soon. When, we don't know. India is going to be at least for 2 years. We feel that it should take at least 2 years. But if you are looking for surety support outside India in a market which accepts sureties, we would be happy to support you. Next slide, please. Now, I think I have already given you a perspective. Basically, sureties give you, you don't require a guarantor. You can diversify your source of guarantor. You don't need to give collateral. Prices are more or less same, but the benefit what people look at is that you don't have to block your assets, which you can probably use for more of funded lines rather blocking it for non-funded lines. Many a market, like for example US and many markets, they are insisting on surety only. So basically, people give the bank guarantee to a surety company, and then surety company provides a surety. So what we do is we understand what your requirements are. Slightly the diagram is slightly hazy, but we basically understand. We go to the market, seek quotation, arrange for the indemnity to be signed. Once it is signed and your facility is up and running, then you can draw it like any CC facility which you sign with your banks. Not a very complicated process. Actually, the most tricky part are point number 2 and 3, where getting underwriters agree or to issue facility to you, and signing of indemnity bond, because that is a legal document which binds a company. Barring these two things, rest all is not that difficult. One more topic of political risk insurance. I will just introduce you, and if you have an interest, I can see from the audience, many of the people, I have already spoken about political risk in detail. I have been in this line for so long, and Pune have been my favorite market. Many of you have already bought these covers with us, but I'll just take you through. So there is a definition of political risk, but to understand the concept, any action or inaction of host government, that is the country in which you are working, or a third party government like say US or UK or UN body, which prohibits you to either repossess your assets or repatriate your profits, is a political risk situation. So action or inaction both. Uh, for example, if I can give you an example of an action was something which happened to GMR in Maldives, where after constructing the airport, they were asked to leave. That's an action. That was an action by the government, host government. Inaction could be when in Libya, when the government fell, one of my client had a $10 million rig, and government was not able to protect their asset. They just had to run away. That was a case of what we say. Uh, 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 Post-abandonment, wherein they had to abandon the asset and came back. In India, we have seen nationalization 1977. So these are our political risks for which you are against. These policies are bought by either contractors who are doing projects abroad or companies which are investing abroad. So we have seen claims, large claims. These are low frequency, high value claims. What all is covered? Things like license cancellation, unilateral license cancellation, expropriation of the asset, forced divestation, where they're forced to divest out of the asset, non-payment by the principal, selective discrimination. Like, for example, somebody might say that you are an Indian company and you're not paying anything to Indian companies. Contract bonds, that is unfair calling, where you have done your work, still they have called. Like, for example, Lenco, which was a prominent contractor, when they fell into financial trouble, they just invoked everybody's bank guarantees. That is, contract bonds were invoked. Confiscation, nationalization of the assets, embargo, and currently when we are talking about a situation which is economic crisis, and I am expecting, and we are seeing it around, a huge political crisis which is being built up, which could result in an embargo or a deprivation or purely unilateral contract frustration. So these are the risks which we are living with, and political risk insurance helps mitigate these risks. Next slide, please. There are different type of covers. Obviously, it's an organized market. Almost 42 players are there in Lloyd's. There are about 20 odd players other than Lloyd's. About 60-65% companies are delivering these type of products. Uh, okay, you have moved to the next slide. Basically, the process remains the same. Understanding what risk you are looking at and suggesting what you should buy and what you should not, getting to the market, getting commercial terms. The most critical aspect of this business, and I think that is where you should have an intelligent partner, is the policy wordings, because these are the crux of what is covered and not covered. And I know one of the large Indian corporate who bought a policy for their investment in Maldives, and when country stopped and they ran out of forex, what they have been given a deal is to collect the money in the local currency. Now what they will do with that? Okay, and now they are asking for currency inconvertibility cover. And I said, when we connected with them, we said, sir, this is the first thing what you should be looking at in a country with such a small foreign exchange reserve. Oh no, that was not advised to us. But can you get us now? Now you cannot get it because the building is already on fire. So I'm saying it is very important that when we are looking at a country, and I think recently Anand must have shared, or Marsh communication must have come to you, where we have spoken about the new risk updated map. And I think that is also equally important that you should look at it. Policy wordings are key. Rest all binding and start of the policies are nothing. The best part about these policies are that these are multi-year policies, can go up to 15 or 25 years. And these are non-cancelable policies. So once an underwriter has bound themselves with you, they cannot cancel the policy. Only you have a right by non-payment of premium. So I think that is something you can always look at. 2 years or 3 years is something anybody can predict, but nobody can predict maybe 5 years or 10 years down the line. And frankly, when we say 3 years is a predictable period, maybe people who were wishing each other happy 2020 never wish that by Feb, March, this situation is going to hit us. So world is uncertain. We don't know what will hit us when. Insurance is one way to mitigate your risk. And I think Nitin will agree, because we ourselves have worked together for a very long time. But we don't know when things will hit us. It is always good to not only, I'm not talking about from insurance perspective, from this perspective, we should know what we want to carry in our books and what we want to transfer. And that is what Marsh's job is, to assist you, that you should keep this in your books and this is possible to transfer it. I think that's all. That's the last slide, Anand.
Correct, correct.
Yep. We are happy to answer your queries. I'm sorry, slightly overshot the time, and that's why I just requested Abdul. I'll come on board. Happy to address your queries if somebody have a question. James sir, have we covered all aspects?
Yes.
Right.
Actually, you did our job in the
Thank you,
first
Abdul.
15
Thank you,
minutes.
Akshay, for your.
Actually, there was one question. Did you answer that, or would you want to?
Yeah, there were two questions which I already. If anybody have a live question, we are happy to address that.
Or would you want to explain these points once again? Maybe.
Yeah, sure.
Yeah, we have time.
So the first question which came from Amonji was, what could be the right method to rate a customer from creditor's perspective? As I have answered, see, broadly, there is no right or wrong. Underwriter assess a buyer risk for two aspects. One is they see what is the track record of the buyer, how they have been paying to their sellers and bankers, etc. Second is they see that in case of a non-payment, will they be able to recover? buyer. So these are two aspects. Now the beauty where an underwriter differs from a banker is that banker can only do an objective assessment, which is based on ratios and numbers, while a credit insurance underwriter does objective and subjective assessment both. So while they will look at objective factors like which sector you are in, turnover, profitability, various ratios, quick ratio, these all things, but they also do a lot of subjective ratios, subjective assessment like how critical is your relationship, what has been the past track record, who are buyers buyer, what type of order book they have, what is the trading history, how has been the DSO. So all these factors actually help probably underwriter do a more holistic assessment. Yeah, sometime maybe what I think that is the reason probably, because with banks what is happening is as Basel norms are becoming more and more stronger, it is becoming very difficult for them to extend credit where they're not able to rate. But here underwriters actually provide a lot of support in terms of this thing. Amolji, have I answered your query, sir? Okay. Second question. Yeah. Second question was raised by Yogesh, where he asked, does TCI come with LMA 5393 or a similar communicable disease endorsement? Because these wordings, endorsement wordings are pretty exhaustive and vague. You are correct, sir. With your experience, I was expecting something like this. See, frankly, we have been seeing a push from the market.
Mr. Yogesh is, we have unmuted Mr. Yogesh. Mr. Yogesh.
Yeah, Mr. Yogesh, if you want, you can ask this.
So, Akshay, thanks for a wonderful session. I have seen this endorsement getting added to every class of insurance. So I was just wondering if the same is attached to trade credit insurance, then the current scenario might just get excluded. That was my question.
Yeah, see, I'll give you answer. One is, yes, insurers have been pushing for it, and luckily none of our clients have yet seen this endorsement in their policy. Thanks to a collective push from Marsh globally, and it is not just India win, but collectively we have been able to push. One. Two, what this policy covers is non-payment because of insolvency or willful default. And this is very important to understand. If the non-payment happens because buyer has gone insolvent, then your case is crystal clear, you will get your claim. In case he doesn't, so when we talk about protracted default, which is the other peril, what it covers you is, and the basic definition is, that the buyer should be solvent, he has not paid on due date, there is no dispute, and on the invoice. So if your invoice does not have a dispute, the due date has crossed and the buyer is solvent, it will be categorized under protracted default. Now, if your buyer has not been able to run his factory because of, say, COVID, and you want to give him concession, that is okay. If he is not paid, it will fall into protracted default, and the claim is anyways tenable. Now, this can happen because of pandemic, non-pandemic situation does not make a difference. To give you an example, when SARS happened in, it was a big issue in Far East and China and other countries. There were claims at that time, big claims, and they all were paid. Many people did show various exclusion, but credit insurance that way I think is a pretty practical policy. This guy is not paid. Now, it could be because of a COVID situation, non-COVID situation. We have not seen anybody not paying claim in credit insurance because of this. And see, frankly, we have not got any such endorsement also in our policies. So please do not worry. If you have a claim, if you already have a policy, it will get processed.
Yeah, this answers my question. Thank you.
Sure, we have
Actually, we have a couple of more questions that have come in.
Yes.
Mr. Dimanshu Mandirata asks, if we give material to a customer and they didn't pay the amount to us, we claim the amount from you, and this is not even, and then he's not even paying you, the insurer, and then there's a requirement to go legal. Will it require our involvement, or would that be completely taken care by you?
Yeah, Dipanshuji, thank you for this query. I think this is a very interesting thing, and this is something which I was talking about. The benefit of trade credit insurance is that it gives an end-to-end support to you, wherein it, so say for example, if he fails to pay you and then to insurer, then insurer may go legal, and if they go legal against them, you will have to support the insurer. Credit insurance does not pay 100% of the risk. It pays 85 in India. Globally, it is 90. This 85% of the invoice value is because of IRDA requirement. So 15% debt will always remain in your book. And many countries, it is required by law that the original seller should file the claim. The best part is that you will only have to represent and support the insurer in recovery. Insurer will decide the legal course of action, will decide the lawyers, and will take it to the logical conclusion. You will have to bear only 15% of the legal cost. 85% is borne by them. Additionally, if the recovery happens, then some insurer first deduct their share of money which they have already paid you. Some insurers have this concept that every penny which comes in get divided into 85, 15, 85 remains with them and 15 comes to you. So you have a better chance of recovery. You have got experts doing it, and I think that helps you. So does that answer your query, sir?
And a less hassle for you. You know, it's completely insurance company driving it. You know.
Rupesh, you have asked in India what could be the premium cost. GG.
Right. So the question is, in what will the premium cost to cover domestic as well as export receivables, and whether the cover is available for a buyer-specific risk?
I think Atul answered it. In India, IRD have restricted us for a buyer-specific single buyer cover. What they ask you is that you can have a portfolio or a whole turnover policy. That is part one. Two, premium costs have jumped up, and there is no standard rack rate available, barring ECGC, which has still a rack rate concept. Premium rate now depends, like for example, one trend what we are seeing is that insurance company first do a buyer assessment to see whether they'll be able to cover your buyer or not before giving a quote. And the prices have jumped up from about, as I said, 20-30% from base level to 100-200% from earlier. So I'm really sorry, but I'll not be able to give you a price range or a pricing how it's going to be. But broadly, if you see, it will be around, depending upon turnover, around 7-8 basis point to recently we had this case where we have got 0.26 of insurable turnover. So it depends.
And actually, I want to add one line here that whoever have bought this policy have continued this policy, which means it's made a business sense for all the clients.
We have people buying in India also. There were people who have bought this policy in 2003-4 when ATDS New India started. There are people who have been buying the policy since then. And to give you an example, there have been cases where policies have run claim-free for 4 years, 5 years, 6 years, as Judge James has said. And then we had these catastrophic claims of 15, 16 crores at one go, and they were paid. I think it has to be looked at from a long-term perspective because it provides a lot of softer aspects vis-a-vis other policies, like how in health, we are seeing, earlier it was just health insurance, now it is employee benefit, as it is called. There is a lot of other activities which are surrounding health insurance. Same way, credit insurance has always come in a package in terms of credit benchmarking, information on your buyer, right amount of exposure, debt recovery, legal assistance. So all these come, and that I think that is where people see a lot of strength. Mr. Guru Prasad have asked, hi, can you please throw some thought light on counter guarantee, which will be operative in India shortly? Mr. Acharya, see, these counter guarantees which we need to give are pretty popular globally. And that has been our wish and push from Marsh as well as some other stakeholders to the regulator, that is IRDA, as well as various ministries where we have made our perspective. A case was presented even at Davos in World Economic Forum, where a lot of leaders from India were there by our this thing, because this is a huge untapped market and a requirement in India. How we look at it is that as soon as this gets started, the committee will submit the report. The first committee which has been formed will submit the report by end of November, is what I'm expecting. Once it is, the report is submitted, I think it will take about 1.5 years for this to start, because it has got RBI as a stakeholder. Be a challenge, legislation which might be required to bring surety underwriters at par with banks because they are providing guarantees. So yeah, a lot of work has to be done. So it's not going to come simply a start. What we are talking about is we can support our Indian clients who wants these counter guarantees to be issued outside India in a country where surety is acceptable. Do I address this, sir?
Great. I think we have answered all the open questions. If anybody else has any questions, and we are bang on time actually as well. So if anybody has any questions, we are obviously available offline. And we can you can always talk to the person, the CE who's connected to you, and they will of course route the questions to the right colleague in Marsh India as well. Thank you everybody for your time on the call. Thank you Akshay, thank you James sir,
Thank you.
thank you Atul for your time.
Thank you, James, sir. Thank you all.
And have a very pleasant evening.
Thank you, everyone. Take care. Stay safe. Bye-bye.